Hi, welcome to the Commonwealth Market Update for August. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. We've got a lot to talk about this month. Three major things. First, the U.S. economy. Second, the international turmoil. And finally, what U.S. markets did at the end of the month. Let's talk about the economy first. We walked into the month with some concerns. We knew we had a terrible first quarter. We were very concerned about what had happened in the second quarter. We thought it was going to be good. We thought it was going to be good for a number of reasons. First of all, employment continued to grow strongly. We just had the 6th month in a row of 200,000 plus gains in jobs. That's the best in 17 years. We've seen wage growth continue, although not what it should be. We've seen housing continue to appreciate, but slow down. Should we be worried? As it turns out, no, we shouldn't. The quarter came in with a growth of 4%, which was well above expectations. Not only that, the terrible results for the first quarter were actually revised up from minus 2.9 to minus 2.1. The employment growth also included upward revisions as well. So overall, we're continuing to see things normalize. We're continuing to see things move in the right direction. The jobs we're getting are good jobs. We actually see more full-time jobs being created and fewer part-time jobs. So the job mix is actually moving towards full-time and away from part-time. And if you look at the way that jobs are actually being created, the creation mix is just about the same as it was in the mid-2000s. We have a sustainable recovery. The U.S. economy is actually doing better and doing so at an increasing rate, which we've talked about. So on the whole, we don't have to worry too much about the economy in the U.S. So what do we have to worry about? Well, that brings us to point 2, international turmoil. We had a tragedy, the shooting down of the Malaysian airliner over the Ukraine, that just highlighted just how uncertain the political situation in Eastern Europe is. Russia and the U.S. and Europe are continuing to impose sanctions on each other. And the reality is that's a very fluid situation and one that could continue to get even worse. Europe itself is getting hit by economic slowdown. There are still risks there. We had a Portuguese bank, run into serious problems which shook the markets. We've had Bulgarian banks do the same thing. Not only that, and as a surprise at the end of the month, Argentina defaulted on its debt. I say surprise, it wasn't much of a surprise, but the surprising thing is the effect it seemed to have on the markets. Because the thing is, it was well telegraphed. In fact, it wasn't a surprise, and it shouldn't have had the effect that it apparently did. We got a drop in the U.S. markets at the end of the month because of that. What does that say to me? Well, first of all, it says the U.S. markets could be considered to be in a precarious state. We actually have improving fundamentals. We saw 3/4 of companies so far towards the end of the month that had beaten the estimates for earnings. We had almost 2/3 that had beaten the estimates for sales. And yet, the market remained vulnerable because of that news, which wasn't that much of a surprise. What does this mean going forward? First of all, it means the U.S. recovery is going to continue and will probably continue to benefit from uncertainty elsewhere in the world. Second of all, volatility in the financial markets is very possibly going to continue as well. We remain confident in the markets. We don't see significant evidence of any reason to worry a lot, but we're keeping an eye on it. So, solid U.S. economy, solid fundamentals, markets a little wobbly, something we're going to be watching. Thank you for watching, and I'll talk to you next month.